Amazon is spending $200 billion this year on artificial intelligence. That is more money than the entire economic output of grief. And last week, they invested $50 billion more directly into OpenAI, the single biggest corporate bet in history. So is Amazon building the future or burning through cash? We're going to examine the data together, and you can draw your own conclusions. Here is why this story matters right now. Amazon stock has dropped nearly 20% from its highs. Wall Street is nervous about the spending, but 54 out of 58 analysts still rate it a buy, and Morningstar says the stock is 20% below what the company is worth. Something does not add up. Over the next 12 minutes, we figure out which side has it right. So what is Amazon actually today? Forget the bookstore. Amazon in 2026 is three massive businesses: the world's largest online store, the #1 cloud computing provider through AWS, and the third biggest digital advertising platform on Earth, bigger than TikTok and Snapchat combined. Only Google and Meta are ahead. Here's the number that changes everything. AWS makes up only 18% of total revenue, but it generates close to half of all operating profit. The margin is 35%. The retail side runs on razor-thin margins. When you hear Amazon, think cloud computing giant that also happens to sell everything on Earth. Now the latest results. Amazon reported fourth quarter 2025 on February 5th. Revenue hit a record, over $213 billion in a single quarter. That beat Wall Street by roughly $2 billion. Growth was 14%. For context, Amazon added more revenue in one quarter than most Fortune 500 companies make in an entire year. But the stock dropped 8 to 10% after hours. Earnings per share came in at $1.95 versus $1.97 expected, a miss of just 2 cents. Nobody would normally care about 2 cents, but investors were not looking at the earnings. They were looking at something else entirely: the spending. Amazon announced plans to spend $200 billion in 2026, nearly all of it on artificial intelligence data centers and custom chips. That is 50% more than last year. It raises a question every investor should ask: when does this spending start generating returns? Over 5 years, the transformation has been remarkable. Revenue nearly doubled from $470 billion to $717 billion. Net income went from a loss in 2022 to $78 billion in profit. Operating margins more than doubled. Gross margins reached 50%. Amazon figured out how to be both massive and highly profitable. But free cash flow tells a different story. It collapsed from over $33 billion in 2024 to roughly $8 billion last year. That is a massive drop caused by the accelerating capital spending. Amazon is more profitable than ever, yet cash available to shareholders is shrinking fast. That tension defines the investment case right now. Now the growth engines. Starting with AWS, the crown jewel. Last quarter, it generated nearly $36 billion in revenue. Growth was 24%, the fastest in over 3 years. The annualized run rate is $142 billion. AWS alone is larger than most technology companies on the planet, and it is accelerating. The backlog tells an even bigger story: $244 billion in future contracted revenue, up 40% year over year. Companies are signing multi-year commitments because they cannot afford to lose access to AWS. That is not just growth, that is a competitive moat being reinforced in real time. Amazon is also building a custom chip empire. Their Bedrock platform for artificial intelligence is growing 60% every quarter. Their Trainium chips generate over $10 billion annually with triple-digit growth. Every dollar on Amazon's own chips is a dollar not going to NVIDIA. Amazon is quietly becoming one of the most important AI hardware companies in the world. Then came the biggest deal of the year. On February 27th, Amazon invested $50 billion in OpenAI. AWS becomes the exclusive third-party cloud provider for OpenAI's enterprise platform. OpenAI committed to 2 gigawatts of Amazon chip capacity. The agreement expanded by $100 billion over 8 years. ChatGPT's parent chose Amazon for its enterprise future. There is a growth story most people overlook: advertising. Amazon's ad business made over $21 billion last quarter, growing 22%. Prime Video reaches over 300 million viewers across 16 countries. This segment barely existed 5 years ago. Now it is one of Amazon's fastest-growing profit engines. On the retail side, Amazon shipped over 8 billion items with same or next-day delivery last year, up 30%. Everyday essentials like toilet paper and cleaning supplies now account for 1 in every 3 items sold. Not glamorous, but incredibly sticky. Once people buy their basics on Amazon, they almost never stop. Now the price. Is Amazon cheap or expensive? The forward price-to-earnings ratio is about 26 times. Walmart trades around 30, Microsoft around 35, Alphabet around 22. Amazon sits in the middle, which is reasonable given its growth and margin profile. Morningstar values Amazon at $260. The stock is around $205. That is a 20% discount to estimated intrinsic value. They give Amazon a wide economic moat, their highest competitive advantage rating. The average analyst target is $285. That implies 37% upside from here. Now the risks, because no honest analysis skips this. Risk number 1 is the $200 billion spending plan. If AI demand slows or cheaper alternatives emerge, Amazon could face overcapacity and years of depressed cash flow. This is real. Free cash flow already dropped 70% last year. Risk number 2 is cloud competition. Azure grew 39% last quarter. Google Cloud grew 48%. AWS is still the leader, but its share has declined from 50 to about 30% over several years. Both competitors are investing just as aggressively in artificial intelligence. 3 more risks. The Federal Trade Commission and European Union both have active antitrust investigations. 60% of revenue comes from consumer retail, vulnerable to any economic slowdown. And executing $200 billion in spending while integrating OpenAI and scaling custom chips is one of the most complex operational challenges in corporate history. Now for our POW analysis. POW stands for poverty or wealth, and it is our framework for examining a stock across 6 criteria. This is an analysis, not a recommendation. We are going to show you what we found in the data, where the strengths are, and where the concerns are. Growth scores 17 out of 20. Earnings growth is strong, with analysts projecting acceleration into 2027. Revenue is growing above the sector average. Margins have expanded dramatically over 5 years. The addressable market across cloud, advertising, and e-commerce is enormous and still expanding. Financial strength scores 14 out of 20. Revenue has grown every year for 5 consecutive years. Margins are sector-leading. Return on invested capital exceeds the cost of capital, meaning the company creates real economic value. But the free cash flow collapse is something we take very seriously. Competitive advantage scores 17 out of 20. Amazon rates very high on switching costs, network effects, brand strength, and scale advantages. The moat is wide and mostly strengthening. Cloud share erosion deserves monitoring, but the OpenAI partnership works against that trend. Valuation scores 15 out of 20. The stock trades at a meaningful discount to fair value and at reasonable multiples versus peers. The forward PEG around 1.9 is fair but not cheap. Management scores 8 out of 10 for consistent execution and strategic vision. Risk scores 6 out of 10 due to regulatory pressure, massive spending, and competitive intensity. Total POW score 77 out of 100. POW, good. The biggest strength is the growth and competitive position. The biggest concern is free cash flow under pressure from $200 billion in spending. Remember, this score reflects today's data. It will change when new earnings come in. Amazon is making the biggest corporate bet in history on artificial intelligence. The stock sits 20% below fair value. 90% of analysts say buy. But free cash flow is under severe pressure, competition is intensifying, and regulators are watching closely. The bull case and the bear case are both compelling. That is what makes this stock so interesting right now. Amazon has been here before. They bet aggressively on AWS when nobody believed in cloud computing. That became the most profitable business in technology. Whether this generation of spending delivers the same kind of returns is the central question for the next 3 years. Next week, we analyze NVIDIA. You do not want to miss. This video is for informational and educational purposes only. It is not investment advice. Always do your own research and consult a qualified financial advisor before making any investment decisions.